Robschild, no investment advice. Welcome to the show where we view financial markets using technicals, macro, Benjamin Graham's investment philosophy, and of course, crystal ball gazing. Today is Wednesday, October 2nd, 2024. Today's episode, we're going to start with some data that came out today, which can be a decent leading indicator for what's going to happen on Friday for the non-farm jobs report. The ADP employment for September came out a lot higher than expected, and the last reading of this is still not like a great number. 150 is still on the low side, but it looks like the market was expecting more weakness here. Now, interestingly, with this number coming out, the market really took it as a nothing burger because the Fed funds futures didn't really change at all. We're still expecting the three more cuts throughout the rest of 2024, and still possibly even 4 cuts. The most important number coming out this week is obviously on Friday with the unemployment rate. Next, we're going to talk about Walgreens stock. I bring up Walgreens stock because I watched Gareth Soloway's show on Verified Investing. He brought up Walgreens stock as a potential value bargain stock, and I want to go through why this is not a good idea. The stock ticker symbol is WBA, Walgreens Boots Alliance. Now, on first glance, you might be asking yourself, well, Robschild, I thought you were a value investor. I thought you wanted to find stuff that was really cheap, and I love Walgreens. There's a Walgreens right down the road from me. And that's what they said about Sears. Not that this is necessarily going to go bankrupt, but we need to look at the numbers and take them seriously. So, first of all, on a historical basis for the price of the actual stock, this is extremely, extremely cheap, trading at $8.70. The last time this stock was that cheap was in 1996. If you bought it then, you would have done really well for yourself buying a dividend stock that, pays you out all this money, and we got all the way up to almost $100. Would have been a great deal. But is it still a great deal today? We'll start by taking a look at the earnings. Heading over to macrotrends.net, if we take a look at earnings per share over the last 14 years, we can scroll down. They have this nice trailing 12-month chart. You can see that, on average, it has been has been going up in its ability to earn money. But over the past few years, we've had some, 2020, we went negative earnings, which is like a little bit of a crack. And then more recently, from 2022, this company has been bleeding money out. But, going into the future, maybe it can recover its earnings potential, and that would be great for a stock that's only $8. If we got a $4 earnings for the year, that's extremely cheap. That would be a PE ratio of 2. So yes, on first glance of this metric alone, it looks extremely cheap and potentially a bargain stock to buy. Next, we'll head over to Yahoo Finance and you can click historical data, you go to dividends only, and we can do max period here, apply that. And as you can see, the dividend record has been very, very strong for a long time. And the dividends, even throughout the great financial crisis, this company was able to increase its dividends paid out to shareholders. Also in the dot-com bubble, we went from 3 cents to 4 cents to 5 cents. That's really good. Its dividend record has been very solid, going up and up and up all the time, all the way until February of 2024, when they finally decided to cut the dividend down by about 50%, it looks like. So Benjamin Graham would say this is a huge red flag here, not because they cut the dividend, but because they're still paying a dividend while they're bleeding money. Well, maybe their balance sheet is really strong and they'll be able to survive this just fine. Let's take a look. So we'll go back over to Yahoo Finance, and we're going to click on the financials, and we're going to click on balance sheet. And we're going to see, okay, well, how are they going to do over the next year? Their current assets, what you do is take a look at their current assets. What do they have immediately available to pay for borrowing money, and their current liabilities? Are the current assets above the total liabilities, as some companies have, or the current liabilities? These are things they have to pay within a year. No, we have 24 billion owed and only 15 billion of current assets. This is already a little bit of a sign of stress. Did I say a little bit? It's stress. Where are they going to get the money to pay off their current liabilities? Are they going to borrow money? Are they going to go to the bank and say, hey, we need more money to pay off our debt because we have too much debt and now we need more debt to pay off our debt? If I was thinking about lending money to this company, I would be a little cautious here, and I would think to myself, okay, well, let's say that they continue to lose money and they go bankrupt. Well, what do they own? What if they do go bankrupt? Because what happens in bankruptcy is the company has to sell everything that they own, and then they distribute that money to the bondholders, and the stockholders go to zero. Well, the way we're going to do that is we're going to take the current assets, that's about 15.5 billion, and we're going to take a look at this thing called the net PPE. This is all the stuff they own. This is the land, all of the physical things that they could sell in bankruptcy. And this is currently valued at 33 billion. Benjamin Graham recommends to take this with a large grain of salt because, especially if you have a downturn of an economy and you were to liquidate this company, you would not be getting $33 billion. This is like an optimistic number. You typically want to take this number and cut it by half. You want 50% here. So let's cut it in half. That's 16 billion. So 16 plus 15, that's 31 billion, 31.5 billion. Okay, so 31.5 billion, it does cover the current liabilities if they were to sell everything. I mean, let's assume the best. Let's say that you can even get 33 billion for the net PPE plus the current assets of cash and, the real money worth stuff they have. Well, what's that? That's about 45 billion. So that definitely covers the current liabilities, but it nowhere near covers the total liabilities. If I was the bank and I was looking at this company trying to borrow money from me, I would be concerned. I would be concerned, and the market is concerned. So much so that the bonds have been downgraded to junk bond status. This company's debt is currently junk bonds. They're BB bonds, and we'll take a deeper dive into the bonds, the debt of Walgreens in a second. But before that, I just want to mention, is it wide moat? So Benjamin Graham talks about what's wide moat. So wide moat means that it's a large company and it can't really be beat. Like, it has a place in society where, people will just go to Walgreens. They'll just always use it. So they might have a little bit of wide moat, but not so much wide moat. After all, at the end of the day, what is Walgreens? It's just a pharmacy. This is not, Nike shoe brand. This is not Coca-Cola. This is not Apple iPhone. It's not that wide moat. And so I would not give it the benefit of the doubt as in the terms of having wide moat status. So let's dive into their debt and their bonds a little bit here. This is back at macrotrends.net. We're going to take a look at total liabilities. If we scroll down to this is a quarterly values of their debt that they hold. So it looks like once we went into COVID and they had a little bit of negative, that little dip into negative earnings before they got really bad, we jumped from borrowing only 40 billion from 2015 all the way through 2019 up to 66 billion. So they did find somebody to buy their debt So at that time, you know, we're going to move over now to public.com. We're going to take a look at the corporate bonds themselves. So when this chart goes back to 2019, and so 2019 and 2020, we had this little, that was the COVID crash right there, that little dip there. But all in all, throughout 2020, we had a yield of 3% on these bonds. And, the price of these bonds was relatively high. But then going into 2022, we started getting really deeper into junk bond status, to the point where today, this is updated as of yesterday, it looks like October 1st, we now have a 7.6% yield on these bonds. Not only does their debt now cost more, and the market is basically, not happy with this debt. I mean, why would you be happy with this debt, especially of a company that is still paying a dividend to the stockholders? They're paying the stockholders, all while, the bondholders are flipping out. This is not good management. This is terrible management. Walgreens is not a bargain deal. And if it was a bargain deal, you wouldn't look at the stock price. You wouldn't look at buying stocks. You'd look at the bonds. You'd be buying the bonds. A bargain deal in something that is like this, that is in this situation, you're going to get a lot more capital appreciation and a lot more safety in your security purchase by getting into the bonds. And these aren't even like crazily discounted yet. If you want to play this, you got to look at the bonds and wait for them to even get cheaper here. But again, the biggest turn off for me for this company is the fact that they have a lot of stressed debt and they're still paying the shareholders out. This is not okay for me. This is not a value bargain stock. Garrett Soloway on his show said, it's these kinds of purchases that make billionaires, that, they just buy up all the shares for super cheap. And I'm not saying that they can't come out of bankruptcy here. I'm just saying the safety is not there. I don't see the safety. It's not in the numbers. If it was, this could be an interesting stock to get into, but it isn't for me. Next on the agenda, Rosh Hashanah is tomorrow, meaning that we could see lighter than normal volume. Usually when you get lighter than normal volume, it means more of the professionals are not playing the game. And so you get people that are shorting that are not shorting. So what usually happens is the market will just like float up tomorrow. But again, really, it's all about Friday this week, the unemployment rate. I will not be reading the daily reminders. Watch Monday's show if you want to see me go through that. Nothing has changed in any of these daily reminders, nor the crystal ball reading that there is a market crash incoming, in my opinion, and that the Fed won't cut fast enough to save the economy. On to the charts. This is the S&P 500. I mentioned yesterday or over the past few days, it looks like, this is not hard to see. I think it's hilarious how many indicators people try to use, and 5-day average, 18-day average, 100-day average, 200-day average. Like you can see what's happening in the chart. Is it going like this? Is it curling over? Has it been curling over for a while? Has it gotten to a point and going sideways? Like it's just, you just use your eyes, guys. And this curve here looked like it was getting up here. We have a curve, and I said it looked like it was curving down, and it's still curving down. It looks like it'll probably get halfway between these two white lines before maybe fighting a battle and then figuring out where to go from there. I suspect we're headed down to the bottom and much lower, but I'm just the guy with a crystal ball. The VIX, although going down today a little bit, not showing a lot of weakness, suggesting that fear is still, I would say, growing right now in markets. This is going up obviously. TLT, my favorite place to be, finally broke this line. I had commented yesterday how it looked like we were holding the line. The buyers were coming in. Today it changed a little bit. It does have to do with oil getting a little bit of a bid here, involving the Middle East and all that stuff. When oil goes up, yields also go up, and so treasuries do lose value as, in response to oil shocks. So if there's perceived risk of an oil shock, yields go up as a direct result of that. So that's what I think happened with today's candle. Where will it go from here? I'm not sure in the immediate short term. If Friday the unemployment rate comes out wildly higher than expected, then bonds will get a huge bid. They'll go way up, and the stock market should finally start rolling over. Admittedly, October adds to my bearish sentiment. If we get through October without things really cracking, falling apart, the Santa Claus rally, November, December, it's like seasonality can kick in here. Again, with the daily reminders, all the clues are here that there's a major slowdown coming. It's happening while the Fed is still strangling the economy. But if we get through October, I have a little bit more confidence that things won't necessarily fall apart imminently. I mean, this is why I only have 50-something% of my portfolio in TLT, basically, and not 100%. If Friday's unemployment report comes out, if we jump up to 5%, for example, that for me would be, put everything you got into long duration treasuries at that point. That's what I'll be doing. Again, no advice. I mentioned yesterday DXY, the dollar index, had broken out of this consolidation here, and it looks bullish. And I said this looks like it might be a bottom in the dollar, and it's proving to be true so far. The dollar is going up. Everyone and their cousin, again, I listened to numerous people, numerous chartists and technical readers and all of this. Everyone was saying the same thing. Like 98, we were going down to 98 or 96. It can still obviously happen, but in the short term, it looks like, we're going up. It is going up right now. This could be a bottom here, I think. But I'm not like a trader. I just use these things to kind of help give me a sense of where we are more precisely. Lastly, KWeb. This is the ETF that holds the Chinese version of Amazon, Netflix, you name it, website companies. This has been skyrocketing lately. I've been talking about it. I've been holding about 10% of my portfolio in KWeb. In my retirement fund, I actually have CWeb. It's a leveraged form of this. That's been going up amazingly well. Again, long overdue, long undervalued market here. I think a more fair price for this fund is around the $45 to $50 range. So I'm likely to do some kind of trailing stop loss around that level. With now it's like 15% of my portfolio. I mentioned, I can't not mention again, I bought calls too far out of the money. I don't always do the options plays correctly. I mean, if I had just been willing to pay a little bit more for something a little bit lower, it would have made a lot more. But, I was thinking like 49 for Friday, expiring on Friday. So the likelihood of getting that high that soon is basically zero. But oh well, I tried. I only used something like 0.01% of my portfolio for this, like nothing, pennies. I only bring it up because I talked about it on previous shows. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.